All right. So thank you for being patient all morning in the room and everybody on the webcast. So this is the Q&A part. I am the one that's standing between, at least those in the room, standing between you and an amazing lunch outside in the California sun. And I hope everybody on the webcast has lunch plans. So with that, I'm going to turn it over to you for questions. Just raise your hand. There are mic runners. We'll get the mic to you, and we'll jump in.
We'll start here.
Hi, Robert Simmons from RBC Capital. Why do you only look at a one-year payback on the consumer investments?
You know, typically, based on the tax side, typically we focus on ensuring that there is a one-year payback. Now, we also use our judgment to make decisions. We'll make decisions and have in the past that have a multi-year payback. You know, when you look at TurboTax Live, there's huge investments that we're making there that don't just have a one-year payback. And then especially when we look at helping our customers make ends meet, when we look at what we're trying to do with Turbo, which you experienced outside, that is not a one-year payback. So this is specifically has been our tradition on the do-it-yourself tax side because we believe it's the best investment choice to make. But we use our judgment, and there's been many years where we won't just look at a one-year payback.
Hey, Sasan Brenthal with Jefferies. You mentioned earlier that you're doing very well with service-based businesses, but 40% are product-based. Can you just give us an update in terms of how you're doing in that product-based businesses? What are kind of the mile markers you're looking at for continued success there?
Sure. So to build on your question, 40% of small businesses are product-based businesses. We actually have 30% of our QBO customers are product-based businesses. As we look at the e-commerce capabilities that we have versus the capabilities we need to have for our customers, that's really the area where we're focused. And very specifically, the biggest pain point for our customers is they want to see everything that they're selling in one place. They want to understand, are those customers profitable? And then ultimately connecting that to their inventory so they can run their business. Our first mile tracker is ensuring that our customers can actually see all of their orders in one place to be able to better serve the 30% of our customers that are in our base today. But beyond that, we believe we can actually grow the number of product-based businesses by first solving that problem. And then beyond that, we can help them understand profitability of their customers. We can actually help them understand which channels are more profitable and connecting all of that to their inventory. But first mile marker is seeing everything in one place.
Hi, Sasan. Ken Wong from Guggenheim Securities. This question's about TurboTax Live. How should we think about the growth in adoption coming from, whether it's going to be adding more live reps, or can you continue to get the efficiency gains that you guys saw last year when you increased units by 3x while holding reps essentially flat?
Yes. So first of all, we have a lot of confidence in efficiency and effectiveness because as you heard Mark talk about in the platform immersion, this is a technology-led innovation. And we treat it like a manufacturing plant. What are all the processes that you have to go through to deliver for a customer, and how do we automate all of those processes, and how do we leverage machine learning and knowledge engineering to be able to automate everything so that we route the right call to the right pro or enrolled agent, and ultimately making sure they have the insights at their fingertips to be able to deliver for the customer. And our proof point is the fact that we have, we saw significant customer growth last year versus the year prior, but we actually delivered that experience with 2,000 pros. And the net promoter of those pros significantly increased year over year because of that efficiency and effectiveness. So we do have a lot of confidence that we can, in essence, be able to scale this at ultimately maintaining the operating margin levels at the company level. Our number one focus right now, because we are so early, is actually the customer. How do we really nail the first time use experience for customers? How do we ensure we're there for them when they need us most? And then how do we ultimately nail the full service experience that we'll be launching in the coming year?
Right here.
Hi, Dallin Hire, Select Equity. I just have a question on cyclicality. You talk about customers living paycheck to paycheck. Those are typically the ones most susceptible to going out of business during a downturn. And I know that people get laid off, so they start new businesses, and you speak to that. But if you could speak to net customer adds or losses in a downturn, either what it's been historically, how you expect it to look any different during the next downturn?
Sure. First of all, I'll start with history because it's our best teacher. And when we had the financial crisis in 2008, and when you look at our performance in 2009 as a company, we're quite resilient as a company. Comparing us to most of our peer companies, we actually grew revenues 4%, while most of our peer companies actually declined in revenue. And that's primarily because of what we do. We help our customers do their taxes during tax time, and at least in the United States, you still have to do your taxes whether times are good or bad. Now, there may be less folks that are having to file their taxes, but that's an area where we're very resilient. On the small business side, there is an impact, and the impact typically is around your charge volume, how many employees you may hire, bless you. But small businesses actually need us at those times more than ever because they're relying on us to help them get paid. They're relying on us to help them get access to capital. And that was one of the reasons why in the last downturn we were quite resilient, and the number of customers coming in and going out was quite consistent. We believe that it would actually be a bit different if and when we do hit a downturn this time, because most customers are actually online versus desktop, and they're looking for access to other applications, multiple apps to be able to run their business, and we believe that we will actually be needed most in the next downturn than we were even in the last downturn.
Hi, Michael Yao from SciCal. I was hoping you could talk about some of the ancillary services on top of the QuickBooks platform. You obviously have the T-sheets and payments. So what are the areas that you're most excited about for additional growth in that area? And how do you think about doing it yourself versus partnering with somebody like Bill.com or the other partners that you have?
Sure. I'll take you back to the customer problems that we talked about, because that really is the core of what drives all the decisions that we make. And when you look at what we've identified, it's really about small businesses want help to be able to grow. Small businesses want access to their money as fast as possible. They want to be able to get access to capital to be able to get more inventory and grow their business. They need to pay their employees. And so the investment choices that we're making are really all around helping them get paid fast, ensuring that we're leveraging machine learning so we can understand if you're creditworthy and therefore can we loan you money, automating the entire payroll process, and in fact allowing you to hold on to your money the longest, because typically if you have a payroll product, it leaves your bank account about a week or so in advance of having to pay employees. So really looking at automating all of that. It's not one thing that excites us, it's actually the combination of leveraging the ecosystem, as you heard Alex talk about, to help deliver for our customers and really for them to be able to run their business with a phone in their pocket, where payroll, payments, capital, time tracking with T-sheets is all connected. So it's not one thing that excites us when we think about the growth, but it's about the series of customer problems that we're trying to solve that we believe allows us to actually shift from being the source of truth for your books to truly the source of truth for your business. Now, in terms of your other question of how do we think about applications on our platform, what do we build versus what do others build, where do we partner, where do we buy, I would tell you all of that is also driven by our customers and their needs. If you just look at payments as an example, we're an open platform. And so our customers want to get paid the way their customers are willing to pay them, which is why we have PayPal and Square on our platform, inclusive of the choice of using our rails. And so we let the customer drive that choice. We let them ultimately decide what applications that they want to use. And we'll have multiple payroll products on our platform. We'll have multiple payments products on our platform. And we'll also then have apps like T-sheets, like Method on our platform, where whether it's time tracking or being able to grow your business, if we don't have the app, we'll ultimately partner with someone to do it, which is why we have 700 apps as we think about what the possibilities to serve our customers. So what is core for us is really about having a platform that can consume our customers' data so we can innovate for them using machine learning. And payments, payroll, time tracking, capital are really core to help deliver for our customers, and everything else we partner on.
Thanks, Hassan. Josh Beck from KeyBank. So when I step back and look at the day, it seems like retention is flat to improving. You've outlined some pretty bold ARPC scenarios. So it certainly seems like LTV to CAC is moving in your favor. So maybe you could just talk about the trends that you're seeing from an LTV to CAC ratio and how that dovetails into your investment philosophy?
Sure, sure. Well, our investment philosophy is very much aligned with what you heard from Michelle, which is we want to make sure that we can fund the big bets that we talked about today. We want to make sure that we're funding the core innovation and technology capabilities that we need to build across the company. And ultimately, that is what drives where we make choices. And it's all in context of the financial principles. We want to make sure that we're focused on customer problems that allow us to drive double-digit revenue growth, delivering operating income growth faster than revenue growth. So that's one bucket, which is how we think about investment and how we think about ensuring that we stay committed to the principles that we've communicated to you all. On the other side of your question, for us, conversion, retention, and engagement remain the key metrics that we look at. If I just use the small business QuickBooks platform as an example, 80% retention is actually a good place to be because when you look at the other 20%, half of those go out of business. So the opportunity that really remains is another 10 points. And so really the key is continuing to deliver services to drive more engagement on our platform, but to really improve our conversion. Because as I mentioned earlier, there's 155 million folks that come to us and 110 million are not our customers. And the illustrative example we use internally is, we don't sell English bulldogs. People don't come to our website to look at pretty dogs. They come to solve an important benefit, and we believe that's a huge opportunity for us. So really nailing conversion and engagement are the biggest things what we're focused on when you think about the big bets that we talked about, when you think about the core innovation that we're focused on.
Here you go, right here.
Thank you. Vic Kohler. I have a question on tax. Given your increasing mix of free, you had 13 million filers, up 2 mil. Should we expect tax revenue or consumer revenue to be more in the midpoint, 9 to 10%, even for the next couple of years, versus typically the high end?
Yeah, sure. Thank you for the question. First of all, what is unchanged is our strategy that Greg talked about, which is we want to extend our lead in the do-it-yourself category. We want to transform the assisted category, and we want to disrupt consumer finance by solving the problem of helping our customers make ends meet. And what we did last year was not unique to any other year, where we focus on bringing customers in that are fit for our free product. And ultimately, if it means they don't pay anything, we're comfortable with that because we're focused on solving additional problems. And so I wouldn't translate what metrics you heard Greg talk about relative to free as anything connected to a mid-range, low-range, or high end of the guidance. The guidance is 8 to 12%. We're singularly focused on the customer problems and the strategy that I just articulated earlier. And free has always been a very important part of how we drive growth. And last year was actually not unique to any other year.
Thanks. Matt Fall with William Blair. Had a question on the QuickBooks International. So based on the numbers in that slide, it seemed like UK has had the most success. Trying to figure out why that is relative to the other countries. And I know there was some regulation in the UK making taxes digital initiative. How much did that play into the success in UK? And do you need something like that to happen in other geographies to sort of see the same traction?
Sure. So to the question that you asked, last year we grew international subs, 58%. And we look at the countries that we serve in kind of two buckets, Canada, UK, and Australia, where we've hit product market fit. And we're being very diligent about investment levels versus what's possible in terms of acquisition. And then there's Brazil and France and India, which is more emerging markets that you heard Alex talk about. We actually feel very good about all three countries, UK, Australia, and Canada. We have product market fit in all countries. We're investing even more so in the product, investing in top of the funnel. UK just happens to be in a unique situation with making taxes digital, that there has just been, it's been an amplification of growth. And as you heard Alex talk about this, we were actually one of the first to be ready with making taxes digital. And with product market fit, with additional investments, with making taxes digital, you're just seeing a convergence of multiple things that's allowing us to accelerate growth versus other countries. But we feel really positive about all three of those countries. And we don't really need a make taxes digital occurrence in the other countries to continue the growth that we're experiencing.
Hi, Sasan. Kirk Materne with Evercore. When I think about your broader strategy around an expert-driven platform powered by AI, one of the things about these live products would be a heightened sense of engagement with your customers, meaning you're going to be talking to them more frequently. This isn't an annual discussion. This is an ongoing discussion, which when you look at the ARPC opportunity for you that was highlighted earlier, would to me signal that perhaps the iteration around ARPC growth could actually accelerate, meaning you're talking to these people more often. So instead of waiting a year to have them upsell product, you can now, might happen on a 3 or 6 or 9 month basis. So I'm just kind of curious if you have any anecdotal evidence around that, perhaps. I realize it's early, but when I think about the ARPC opportunity plus the fact you're going to be engaging more often, to me it seems like ARPC has a pretty significant way to go if you look at where you're at right now. Thanks.
Sure. First of all, I'll start with the foundational way to think about ARPC is what you heard from Michelle. We really don't solve for ARPC internally. We solve for the customer problems that we want to solve and ensuring that we're ultimately adding value and then making sure that the value equation is such that we deliver against the revenue expectations and the operating income expectations that we share. With that said, I think the hypothesis that you have and the question that you have is a really good one in that we do believe there are possibilities there. And I'll just use QuickBooks Live as an example. And again, as you heard from Mark and Rich, it's very, very early. We're in massive learning mode. It's still early for TurboTax Live. But what we're seeing with QuickBooks Live is that they're actually, their use of payments and payroll, although early, is actually higher than it is for a QBO customer that's not a live customer. And not only is the ARPC of a QuickBooks Live customer higher, but then if they also engage more because they have confidence in the platform and they have confidence in the bookkeeper that's helping them and they start engaging with more payroll payments and potentially other benefits, it could lead to potentially higher ARPC. But it's important that the walkaway you should have is the ARPC is more in line with what Michelle talked about because we're so early that it won't be material. But as you think about the next 5 to 10 years, certainly live expertise delivers confidence. And the more customers are confident, the more they engage with the platform, the more they buy. And so the story that you're kind of articulating that's behind your question could be an interesting one when we think about ARPC.
Hi, Sterling Auty from JP Morgan. Just want to follow up on the question on the free program. Feels like the media hoopla has finally died down, but are all the inquiries and issues behind the company? Definitely. And is it going to change either the marketing or the go-to-market around consumer tax for this season?
Yep. Let me start with just setting the scene in terms of the root cause of what you just shared, which is us being in the media, and then I'll get directly to your question. We have a difference of opinion with our critics. We believe that a consumer knows the story of their life better than anybody else, and we believe that they are the ones that should do taxes for themselves. We do not believe that the government should do the taxes for consumers. In essence, being the ones that sends a bill, audits them, and collects it. And by the way, 2/3 of the consumer population also wants to be able to have control over their taxes. We believe in that. We advocate for that because we believe that's the right thing for consumers, particularly, of course, in the United States. There are critics that believe that the government should do the taxes for consumers. That is not an area where we will ever agree. Those consumers ultimately use us as the platform to be able to communicate what their agenda is. It's not personal. They have their agenda. They're just using us as the market leader to make a broader point through multiple different avenues, Free File being one. So I want to just start with that context, and I do not believe the media attacks will end. They will continue because these are just differences in opinion, and we will continue to stand up for what we believe is right from a consumer perspective. With that said, it absolutely does not change our strategy moving forward. In the last 5 years, we have 55 million customers that have paid absolutely nothing. That's more than the entire industry combined. The Free File program, which is a philanthropic effort, we have been probably the largest donor of that philanthropic effort. And we're going to continue to stay on par with what we're doing. And by the way, the facts are on our side. Now, if we ever see anything that would suggest we need to do something differently, we'll learn from it and we'll adjust. But we feel very good about what we stand for, and ultimately, to set the expectation, you'll probably see more. Because the reality is, just like any other company, when you have critics, the critics don't stop.
Thank you for taking the questions, and thank you for hosting us today. When I was looking at your long-term targets, they're relatively unchanged versus last year, but still sort of fantastic growth. In the 2025 sort of framework, your goal milestone, you talked about accelerating revenue growth, and I want to see if you could be more precise on what you mean by that. Is that, do you think as the business sort of mix shifts more to small business, that's going to have a tailwind on your revenue growth? Or if you could just sort of clarify what you meant about accelerating revenue growth.
Sure. I'll start with what remains unchanged, which is our guidance for the year of 10 to 11% revenue growth, and of course then how we communicated the guidance for each of the business units. And that's, I think, what you all should hold us accountable to, and what we're committed to you all for. Full stop. We have higher aspirations, as we've always had. If I were to remind you of 2008, when Brad took over the company, we were growing single digits, and the aspirations that he set for the company is we're going to grow, double digits, and that was always our financial principles. But several years in a row, we've delivered double-digit growth, and so we've simply set our aspirations to what we believe is possible. And we believe in it because of the customer problems that we're solving. We believe in it because we truly can leverage this notion of being an AI-driven expert platform, to be a platform where us and others can solve customer problems, leveraging AI that frankly existed 10 years ago, but the possibilities are very different today, and what we can do with it versus 10 years ago. And now expertise on our platform that allows us to really go after non-consumption. Really a door that opens for us that otherwise was hard to crack. And we believe, based on the customer problems, based on our investments, based on the proof points that we shared with you today, that the possibilities are greater than what we're delivering today. And so therefore, we've set a goal for ourselves internally. And it's not just financial goals. We've set prosperity goals, reputation goals, and growth goals. And we're striving towards those because we believe we can, and we need to hold ourselves up to a higher bar.
Thank you. It's Jen Lowe from UBS. I think one of the themes that really came through in the digital experience, or walking around the different booths, was the emphasis on AI-enabled services, and obviously that came through the presentations as well. But Michelle's guidance also called for flat gross margins and a focus on growing operating income faster than revenue. We've seen TurboTax Live come in and be very efficient because of the high utilization there, but that is sort of a more seasonal business and sort of a point in time and still fairly young. As you start to get into things like, full service payroll and QuickBooks Live, which potentially could be very large businesses over time, do you see sort of a hard line in terms of how big those businesses could be within the whole, or how do you kind of adhere to those types of 83% sustained gross margins in context of some businesses that could be quite large but also have an intensive people component to them?
Sure. Thank you for the question. A couple of things I would say. One is we have enough experience in the areas that you mentioned that, one, we don't see any structural issues. In fact, what we see is an enormous opportunity to apply technology to be able to get into this notion of connecting people to experts that opens up doors to non-consumption, or folks that would never even think about us, but now they can because we actually connect people with experts. And it is, having years ago had manufacturing experience, this is just like a manufacturing plant, except what's different is we can apply technology. And so we don't see structural constraints, and we still remain very confident with our financial principles that you heard Michelle talk through, in terms of being able to drive top line growth, but also being able to drive operating income growth faster than revenue. And actually, because we're managing margins at the company level, which is very important because we're using platform services, expert services now across the company to, in essence, deliver against what you saw out there. And so we believe we can build big businesses here and do it in such a fashion that, from your lens, we look like a very, very healthy company and abiding by the financial principles that we mentioned.
But Sasan, just a question of capital deployment. Many of us that have watched you for a while saw a phase of M&A, and some of the M&A worked, some of the M&A didn't work too well. You've been a little more gun shy on M&A. You're going to have a capital balance of close to $4 billion by the end of the year, so at least in some of the models.
Yeah.
Do you think differently now on M&A than perhaps some of your past peers or not?
Sure,
Thanks.
sure. First of all, I would start by saying we're not gun shy at all. History can teach a lot of lessons. And, under Brad's leadership, we would study what's going well and why with acquisitions and what's not going well and why. And that's only taught us where it works and where it doesn't work. So one, we're not gun shy. Is point number one. Number two is we're very focused on the customer problems that we talked about today. And where we look at M&A is where there's potential talent, acqui-hire opportunities, where there's capabilities that we lack, and or where it's just a company that we could buy to help us accelerate. Think about one of the bets that we talked about. Is there someone that could really help us accelerate and cut down our speed to market by several years? And so our philosophy actually hasn't changed. I would just tell you we're smarter today than we were 5 years ago and 10 years ago. And that actually gives us more confidence what we should do and what we shouldn't do. And that, by the way, informed several acquisitions that we made. T-Sheets is one. Applatix, which has actually helped us beef up our automation tools across the company. And another recent acquisition that we made that's actually helping us drive accelerated AI application across the company. So we're smarter, not gun shy, but we also want to make sure we're very prudent about how we put the money to use.
Thanks. Hey, Sasan. Scott Schneeberger with Oppenheimer. Just want to go back to something Michelle mentioned with regard to reporting. It looks like you're going to discontinue customer metrics and also tax metrics during the tax season and not until May. Could you just elaborate a little bit about what's behind the thought process there and maybe some areas of focus you'd like the investor to look at instead? Thanks.
Sure, absolutely. First of all, you should have confidence, just as we've done today, that once a year you will have access to a number of metrics that will give you confidence around how we're performing. Two, we will also share sufficient information on a quarterly basis so you have confidence how the company is performing. Specifically to your question about the customer metrics, we're solving for clarity and something that would actually be an indicator for you all versus something that would cause confusion. So let me use a specific example. In small business, as you look ahead, we are now opening our front doors to acquiring customers through multiple different doors. You can just, in essence, come into the front door with T-Sheets. You could come to the front door with payroll. You could come to the front door buying a QBO sub that opens the doors to many benefits for you. And so now what is a sub no longer is the way you used to be able to look at a sub. And so we decided to be able to holistically share with all the metrics with you once a year versus on a quarterly basis, because we believe it will actually lead to more confusion as to how the company is performing versus clarity. And with tax, our plan is just to provide you our tax customer metrics, unit metrics at the end of tax season when we do earnings, simply because of the fact that as we look at just the last couple of years, the tax units have delivered more confusion than clarity when we report them in February. So this is where our entire focus is to solve for clarity and confidence for our investment community, for you to look at what we look at internally. And one key metric in small business we've talked about is online ecosystem revenue growth of 30%. And we want you to just focus on that because that's ultimately will tell you the health of the franchise beyond what we share on a yearly basis.
Hi, Sasan. Karthik Mehta with North Coast Research. Sasan, one of the products you've had success with is QuickBooks Capital, and you've talked about that for the last couple of years. I'm wondering, as you have capital, what type of capital you would use, your own capital, to grow that business, and how much of would you put that on your own balance sheet?
Yeah. First of all, I would reiterate the customer pain point around getting paid, paying their employees, having access to capital. And so we don't look at capital as just a standalone business. We look at it as the power of the ecosystem to be able to solve for customers. And right now we're funding it through multiple avenues. One is a marketplace, which we like and we're going to continue to maintain. The other is we've teamed up with a blue chip firm where we have access to in essence, to their capital. And that's the path that we are moving forward with. And we will ensure that we have access to enough capital, whether it's through the marketplace or even through the partnership we have with a blue chip financial firm to be able to serve our customers. What we don't want to do is become a bank or get close to that line, but we want to make sure that we can solve this problem well for our customers. Any other questions in the room? I can tell you all want lunch. Well, let me, if there are no other questions, let me just maybe share a couple of remarks before, at least in the room, we take you outside in beautiful California for some lunch. First and foremost, thank you for your investment in time today. Thank you for all your questions in the room, and thank you for your support. We are, ultimately at your service when it comes to events like this to help you understand what we stand for as a company, which is where I'd like to end. At the end of the day, we are a purpose-driven company. We are a company that stands for powering the prosperity of our customers all around the world, and we are very focused on doing what's right and standing up for what's right. And I could not be more proud of our team in this room and the 10,000 employees and the many, many partners that we have that help us every single day to deliver for our customers. And so for our employees, for our customers, and my team in this room, indebted to all of you forever. And for all of you in this room, thank you for all your support. Thank you for all your questions. And for now, we will end the session with the webcast. And for those that are in the room, we're going to go outside. The management team will be here, so you'll have access to all of us. And we have ordered sunshine and great food. So we'll see you outside. Thank you very much.